Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about an earnings volatility-crush play. And in particular, we're going to be talking about a 50-50 iron butterfly. Now, before we start, let me just clarify that everything we're going to see here is educational, and this should not be construed as any recommendation to buy or sell any type of financial instrument or any securities whatsoever. We're going to do this for educational purposes. We might be looking at some trades, but it should not be interpreted that I am recommending you to buy or sell any of the examples that we're going to see here. Now, what we're going to talk about here is a very quick and easy way to put on an earnings trade when you don't know much about the company or you don't have any opinion. So we're going to be putting on a delta neutral position where the only thing that you know or the only thing that you think is that you believe that the expected move for that particular stock for earnings is elevated. So all you know is you think that the stock is going to move less than the expected move would suggest. So what you want to do is you want to put on a quick trade and a way for you to profit from it, and also that this particular trade is not an unlimited one, like an unlimited risk one, so that you are protected if it doesn't work out. So you just want to take advantage of the volatility contraction, and you want to take advantage of the fact that most earnings releases, when you quantify the move that happens after the earnings, usually it is less than the expected move would have suggested. Now, when it's higher, so when the magnitude of the move is higher, then usually it does so by quite a bit. It could be 2 times the expected move, or 3 times, or 4 times. But since we're going to be protected, you're only going to be risking 1 to make 1. So without further ado, let's go on to what we're going to be using. We're going to be using an iron butterfly. So just a quick recap of what an iron butterfly is. It's pretty much a straddle with wings. You buy, in particular, if we're talking about an at-the-money straddle, you go to the at-the-money strike and you sell a put, you sell a call, and then on the downside, you buy the wing for the put, and on the upside, you buy the wing for the call. So shorter put, shorter call, longer put, and that's the position. The green area is where you make money. So it's profitable when the move is less than the expected move, which is exactly what we want. And you start losing money up to the point where you have your wing, which is the protection for your trade on the upside and on the downside. So for a quick 50-50 iron butterfly, there's a few steps that you need to do, but they're very simple, very easy. You can take a look at a certain stock reporting earnings. If you see that the expected move is very high, you think it's going to be less, you can apply these steps and try to put on a trade that is going to take advantage of Volatility-Crush, and at the same time is not going to break the bank in terms of if you are wrong, you're going to lose a lot of money. So this is going to be a 50-50. So risk 1 to make 1. So on the day prior to earnings, you don't have a directional outlook, so you're delta neutral. Your assumption is that the earnings move will be less than expected, up or down. It's a risk-defined trade, so there is no unlimited risk. As you can see, even if it goes very low or very high, you're still going to be protected by your wings. So that's one of the characteristics of this trade, and one of the things that makes it suitable for these types of scenarios. Risk 1 to make 1. So what you think is going to happen is that the realized volatility versus the implied volatility on the day after earnings is going to be favoring the implied volatility, meaning that the expected move was higher than what actually happened. And since there's going to be a volatility crush on the next day because the earnings are no longer upcoming, there is no longer an event that's going to move the stock by a lot, then you're going to profit by selling the iron butterfly and then buying it back right after. The actual earnings move is less than the expected earnings move more than 50% of the time. So in some studies, it's been found that it's around 65% of the time. Now, just make sure you understand this. And this 65%, it sounds like it's a huge edge, but in reality, it's not so much, because when it does go higher, then it goes higher by a lot. So it's not only that it's going to be the earnings move could go higher than the expected earnings move, but it could go higher by a lot. So it could be 2 times, 3 times, 5 times. It doesn't matter. There is no limit. That's why if you straight up sell a straddle, yeah, you're gonna win most of the time, but the times when you lose, you're going to lose a lot. Now, how to put it on? So let's go through the steps. So you know that there's a stock that's going to be reporting earnings. You are on the day prior to earnings. You know that you want to put on a trade that tries to take advantage of the fact that you think that the stock is going to move less. You don't know if it's going to move higher or lower, but you do know that the magnitude of the move is going to be less than what the markets are telling you. So the first step is to get the expected move for earnings. Most platforms, you don't need to calculate it. You just go to the platform, get it, and that's it. So you know how much it's expected to move. And if you want to know how to calculate this number, I have a lesson on that. Now, the iron butterfly has 4 legs. The short strike is the same for the put and the call. So the short strike will be the at the money. And now we only need to calculate the wings. For the wings, multiply the expected move by 2. And this will be the width of the iron butterfly. Now you find the strike for both wings as the at the money plus or minus the iron butterfly width, which we calculated here by using the expected move by 2. So you have the at the money right here, and then the expected move multiplied by 2 is going to be the width both on the way up and also on the way down. And that's where you put your wings. The iron butterfly is going to be short the at the money straddle and at the same time long the wings at the at the money plus and minus the iron butterfly width, which is the expected move multiplied by 2. And that's it. You put it on. That's going to be your trade. The max profit should come out to approximately the same as the max loss. So you're risking 1 to 1. Your probability of profit is going to be around 50%. And you will make money if the stock moves by less than the expected earnings move. So this is a very simple way, a quick way. You look at something, you don't know about direction, you haven't done any research on the company, you don't know what's going to happen. Of course, no one knows, but you do notice that the expected move is very high. So you think that the market is overestimating how much it's going to move. Now, you don't know if it's going to go high or low, but you know it's going to move less. Then you follow these steps, which are very simple. Just get the expected move multiplied by 2. Those are going to be your wings. And you're going to get a 1 to 1 risk reward, max profit to max loss. Probability of profit around 50%. And if the move is less, then you're going to profit. And if the move is higher or greater, then you're going to lose, but your loss is limited to what you put in. So basically, you have a defined risk trade. So now Let's go and take a look at how this plays out in an actual example. Let's take a look at Apple. AAPL is a ticker symbol. They're going to be reporting earnings results tonight, and the stock is trading at $291, and we already have the expected move right here, which is just about $11, plus minus $11. If you didn't have the expected move, you can apply the whole procedure that we outlined when we did the expected move for earnings lesson. So you can go back and take a look how we did it. In this case, since it's here, we're just gonna take it and use it to calculate all the different parameters that we need. So Apple is trading at 291, roughly 290.85 here. And what we're gonna do is we're gonna go to the closest at the money strike, so which would be the 290. We're going to sell the 290 straddle pretty much. We're gonna sell the 290 put, the 290 call, and then the move we're going to multiply by 2. $11 multiplied by 2 is around $22. And remember, this is not going to be exact. It's just an approximation, but it's going to be good enough to put on a quick trade betting on something that you that is very straightforward, and you don't need to think too much about this. So 2 times the expected move would be $22. So the stock is trading at 290. So $22 down would be something like 270 to 68. So what I'm gonna do is I'm gonna buy the 267.5, which is the closest one, and then I'm gonna mirror this on the upside as well. So 290 to 267.5 is $22.5, and so I'm just gonna go the same direction, but I'm going to go to the calls. Now we have here a situation where you have the 310, so we would be looking at the 312.5, but it doesn't exist. So what you can do is you can go to the 315 or to the 310. In this case, I'm going to go to the 310. So we're going to have a slightly uneven, a slightly unbalanced iron butterfly, but it doesn't matter. Remember, these are all approximations. These are all just quick ways for you to get access to the market and to get access to option trades that are quick ways to enhance your portfolio returns by putting on these short-term trades. So in summary, we're going to have the 290 call, 290 put shorts, and then we're going to buy the 310 call, and we're going to buy the 267.5 put. Now the expected move is $11. I'm getting 11 in credit, so it's looking good from this perspective. So let's now do a quick analysis. So the first thing you're going to notice is that it's a little bit uneven. So you have a higher risk on the downside than you have on the upside, because the call, we pushed it a little closer to the at the money because it didn't have the 312.5 that we wanted. It doesn't matter. So what we can see here is that we're going to in this strategy, we're going to have a credit of 1121. So these are live numbers. So remember, the expected move is $11. We have a max profit of $11, 1121 right here, and then we can lose 1129 on the downside, and we can lose 879 on the upside. Now, if we wanted to play with this, we could also move the call. Remember, there is no 312.5. So, but we can go to the 315. Now we're going to be taking more risk on the upside. Okay, the numbers are a little bit different. Like now I'm making 1164, and I'm risking. So basically, I can make $1,159, for example, here. And I can lose 1,341 on the upside, and I can lose 1,091 on the downside. So what I'm going to do is I'm going to stick to the 310 call right here. So I'm risking $1,131, and I can lose $1,129 on the downside, and I can lose $874 on the upside. So this would be pretty much a quick 50-50 iron butterfly. Now, if we want to see graphically where the profitable area is, I can just go get the break evens from here. Okay, those are the break evens, these lines, and I can see them superimposed on the actual chart. So if I go here, this is the profitable range. So if by tomorrow, because the earnings report is tonight, so if by tomorrow the price stays within this range, then I'm going to be making money. If it goes higher or lower, I'm going to be losing money, but I'm protected by the fact that I have wings on the call side and on the put side. Now, what will happen if, okay, I like this trade. I'm risking pretty much $1,100, and I can make 1,100 or lose 1,100. Best case scenario, worst case scenario. But what if I thought that 1,100 is too much? I just want to risk. I want to risk less money. I still want to have a strategy that gives me a one-to-one risk to reward, or a one-to-one max profit to max loss scenario. But I don't want to put down $1,100 to bet on this earnings play. Maybe my maximum amount, because of my portfolio size, would be, I don't know, 500, 600, it doesn't matter. You want to make that bet smaller, but still keep the basic relationship, or the basic ratio between max profit and max loss. Well, in that case, what we would do is, instead of using an iron butterfly, we would switch to something similar, and instead of having a 50-50 iron fly or iron butterfly, we would go to a 50-50 Iron Condor. Now we're going to use an Iron Condor instead of an iron butterfly. So if the risk is too high, which is what we were talking about, so you don't want to put down so much money for a single bet, then go to a 50-50 Iron Condor instead of a butterfly. So here's the Iron Condor. I'm not going to go through all the details of it, but basically it's something similar to an iron butterfly, but instead of having the short call and the short put at the same strike, they're spread apart. And now you have a short put spread on the bottom and a short call spread on the top. And that's how you build an Iron Condor. If the price stays between the break-even points, then you make money. If it goes beyond, then you lose money, but it's defined risk trade. The max amount that you can lose is always defined. So what are the steps to get this? Well, it's something similar. You get the expected move for earnings, which is on our platform. It's already there. We need to calculate it. Now, the at the money plus and minus the expected move will be the midpoint or the break even for your Iron Condor on both the call and the put side. So it's going to be somewhat symmetrical. Now you can start your analysis by going to the puts or to the calls. So that's why I'm going to refer to both. Select the short call or the put from the option chain that is before the midpoint or the break even, going from the at the money. So if you start at the at the money and you know what the break even is going to be, which is going to be the expected move, you go there and you back up a bit. And that's when you're going to start analyzing. You're going to go to the break even, which is the expected move, go a little bit lower or a little bit higher in the terms in the case of a put, and then we're gonna build the spread on that side, and if that matches what you wanna risk on that trade, then we're gonna go ahead and just build it by mirroring everything. So Once you select the, you start looking at the short call or the short put that you wanna consider. Now you select the wing for that short call or put that is equidistant from the midpoint break even, but further away from it. Okay, so let's say for example you go to the break even. This strike is $2 under the break even, below the break even. Then you take the break even and $2 higher, you pick that, in this case, long call. So you would have the short call, you need to find your long call, and now you have a short call spread. Because of that short call spread or short put spread, you're going to be receiving a credit. Well, approximately twice the credit received for that short call or put will be the total capital risk, where you're going to go one to one for your trade. So let's say, for example, you go to the break even, you back up, let's say $2 here. Then you go from this point $2 higher. You have the short call spread, and let's say, for example, you're getting $2, or let's say you're getting $150 as a credit. Then you know that you're going to be getting just around $3 for the whole condor, for the whole Iron Condor, because this is going to be the same on the other side. If you are going to be making at most 3, then you're going to be risking 3. And if that's something that you're comfortable with, then at that point you just put it on, and you have an Iron Condor that is still 1-to-1, that is still just about 50% probability of profit, but where you're not putting down so much money as if you were doing the Iron Butterfly. You start adjusting it until it matches your intended risk for that trade. That's what I was saying. You go to the break even, you look at this short call and the long call. If you don't like this, you can go closer to the at the money or further from the at the money, and then you adjust the long call until you're comfortable with the risk of the new position that you're building. The other side, if it's a call, then on the put side, and if it's a put on the call side, will be a mirror reflection of your strikes from the at the money. So max profit is going to be approximately equal to the max loss, 1-to-1. Probability of profit is going to be approximately 50%. And same thing, you will make money if the stock moves by less than the expected earnings move. So let's take a look at the platform to see how this translates into an actual position. So now we're going to analyze Apple, and again, this is not a recommendation to buy or sell Apple stock or options or to put on any strategy. We're just doing this as an educational tool. So don't go out and replicate what we're putting on here, because this is just for you to understand how option pricing works. So having said that, we analyzed a 1-to-1 quick 50-50 Iron Butterfly, and we figure out that we needed to risk $1,100 to make $1,100. So instead of that, we don't want to put down so much money, so we're going to go with an Iron Condor. We start by looking at the expected move, which is plus and minus $11, $11.40. So from the price that right now is 291.5, we would go, in this case, I'm going to start with a put. So I would go to 291 minus 11.40. It's roughly 280. So 280 is going to be my break even or midpoint. And what I'm going to do now is I'm going to pick the short put that's immediately before the break even or the intended break even point. So I'm going to be selling the 282.5, and I'm going to be buying the 277.5, because I'm going to make it symmetrical here. The 280 is the break even, so $2.5 dollars higher and $2.5 lower. Okay. So now that I see that I'm going to be getting a credit of 127. So now that makes a little bit more sense, because this is going to be $120. So what that means is if I mirror this trade and I go to the call side, I'm going to get just around between 235 to 40, and then I'm going to be able to risk less, but still have a pretty much a symmetrical Iron Condor where I'm risking one to make one. So in this case, I'm going to add, now that I have the 280 was my break-even point, right? So now 291 and a half, and the 1140 is going to be 302 and a half, roughly. So I'm going to be selling the 300 and buying the 305. So I'm mirroring what I had here on the put side. So I'm going to go to the 300 and I'm going to sell the 305. So now I have, look at this. Now I have a position that is made up of the short put spread for the 280, 282 and a half, 277 and a half strikes. And then I have the 300, 305 call spread, short call spread on the call side. So we have a short put spread here, a short call spread here, and together they make up an Iron Condor. And that Iron Condor is going to give me 235, so 235 per contract. And let's analyze what happens if we run this through the Analyze tab. So now we have our trade here, and as you can tell, this is an Iron Condor. It looks pretty symmetrical. I can make 236 and I can lose 265, 266. It's changing as prices change. So this is a very symmetrical Iron Condors, which is what we wanted. Now we're going to put down only the equivalent. So now the max loss that we can have is $263. When we were talking about the other strategy for the Iron Butterfly, we needed 1,100, so $1,100. And for this one, we need $240 or $250, 260. So as you can see, we kept the same concept and the same principles, and what we did was we just converted the Iron Butterfly to an Iron Condor, but keeping the same concept. Just expected move too high, you think that it's not going to move as much, you put this on, it's not directional, and you're just waiting for volatility to contract, and that's it. You just wait for the move to happen, and if the move is less, then you're gonna make money. Okay, so now let's get the break-evens for this. So we have the break-evens, and let's see what they look like on the chart. Right, so this is something that's very similar to what we had. We had a for the Iron Butterfly, just about the same break evens, but we were putting down $1,100 because that was the max loss. And in this case, it's $250. In fact, it's much less, and it keeps the same parameters roughly. Now, how would you know if a stock has its earnings move overstated or understated? Well, one way to look at that is, this is more like a trader's art than science. But you can in this graph, I'm plotting implied volatility here, so you can see whether implied volatility is very high or very low, especially compared in the last year where it has been. So as you can see here, the implied volatility is not necessarily super high, but it's higher than before. All these days when the volatility was around between 25 and 30, right now it's 40%. So we expect that volatility to contract. And if you think that the move is overstated, just put this on, wait, and then when the move is less than the expected move, then you're going to profit. Also, A lot of traders, what they do is they look at the expected move. See, everything is based on the expected move. The expected move, which is around $11.40, and you compare it to the stock price. So $11, and again, I'm not even using a calculator. I'm doing everything in my head. $11 to 290. We're talking about a 3%. No, actually more like 4%. 4% move. So the expected move is around 4% of the whole strike price. So some people, what they do is, when it's telling me it's over, let's say 7% of the stock price, then I would put on a trade looking for Volatility-Crush for the move not to be higher than the expected move. And when it's less than that, then I just don't do this trade. I put on some sort of a directional trade if I have a directional outlook or something else. In this case, that's something that you're going to have to decide. For example, for this particular move, Apple is going to move here, and the expected move is around 4% of the price, which in my experience is a little bit low. Usually I like to put on these types of trades. I like to have an expected move that's more in the 6, 7, 8, 9, maybe up to 12, 13, 14% range. So the expected move is very, very high. And in that way, I'm going to get more credit. And the probability of it being less, in my opinion, is a little bit better because the range is so high, right? In this case, the range is kind of small. If you look at the price that Apple's been at, especially in the last months. Okay, but that's something that you're gonna have to decide. What I'm here to teach you is how to put on these trades, how to use the expected move to structure these types of trades, and how you can profit from an earnings move. So I hope this was good and that this was instructional for you, that you guys learned something from it, and hopefully you're gonna be able to take this information, put it into action, put on some trades, make money, and learn in the process. Thank you very much for your attention, and goodbye.